Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our frac spread count show, so we're going to talk about the frac spread count, some of the recent data that's come out that will drive some of the adjustments that we've seen on a macroeconomic basis, and where some of the demand drivers have gone over since we talked about it during the EIA show. So since I was on my hiatus, I know we had a nice little bounce in the numbers. Here we had another increase of +2, so we went from 266 to 268 spreads. When you look at it, the Appalachia went up by 1. You had some small adjustments. Other went up by 1, and the Haynesville. But realistically, so far, oil is flat. We haven't seen too much of a change. Any change has happened more on the wet gas side at this point, and one on the dry gas side. So we should continue to see the shift higher. This is normally kind of around the time that you start to see these increases. But again, we're at 268 and not where we were expecting to be, or at least I was expecting to be closer to about 290 by this point. So you get an idea that, at the beginning of, or I should say the end of last year, we had projected that we were going to have an increase in, or an exit rate of about 12.7 million barrels a day. And now it's going to be something closer to about 12.5 to 12.6, just because we had this big the drop back in some of this activity, and we haven't seen that big increase, which again is going to slow down some of that capacity. Now, when we just look at looking at the seasonality of it, obviously we've had that bounce that you can see, and this is normally when you start to see some increases, but they're on just a underlying basis of seasonality. We typically start to see that grind up, and we should get close to where we were in 2022 when you look at kind of that steady level, and then that little bit of an increase as you go into September and October. But you're not getting the same wild swings that we've had in previous years, because as we've talked about it before, we're moving it more into that manufacturing mode where you have this pretty steady activity. You have your rigs moving at a steady rate. You're having your frac spreads follow it up. And that's been the momentum that we've seen. And again, it's more along the lines of protecting cost, protecting margin, and making sure that you're making money for shareholders versus just an all-out, just complete everything that you can. Now it's a bit more structured, which again is a net positive. When you look at the Permian, we're right back to where we were in 2022. It's obviously very much at the higher end, but here's where we see again that steadiness that we believe is going to continue. And realistically, we should start to see some increases just because it's very hot in Texas for anybody down there. You can't run a diesel engine the same way you do. So you typically bring on a little extra horsepower. You bring on an extra spread. You don't run them as hard. So again, these are some things that you do, or I should say like have spreads running just taking a little bit longer. So you'll have more active spreads that are doing less. And that's just to preserve the engines, to preserve the equipment. But again, that's what we're going to see where things pretty much level out. And it'll still stay at the high end. Obviously, you had some big spikes in 18 and in 19. But as we've gone away from some of those increases, now it's more about the steadiness, the repeatability of it, which we continue to see. So now when we look at rig counts, we had a drop above 10 on the horizontal side. Directional went down, came up by 1. Vertical came up by 1. A drop of 4 oil, 5 gas. So again, gas is especially when you look at pricing at about $2.63. There's really no impetus to add to the gas rigs at this point. Some of the increases that we're seeing, there was 1 or 2 spreads added in gas basins, but again, it's all about maintaining production. It's not about increasing production. It's all about maintenance at this point and maintaining your underlying volumes. So overall, the horizontal continues to move lower. That was something that we were expecting to see a bit of an increase. Now, we had another decrease. So this is going to be an important one to watch, because this is all going to come down to what are the DUCs going to look like, how much DUC inventory we're going to have, and also this also supports some of those views of a bit more of that hesitation, if you will, or the reduction in underlying production. So now when you look at the demand side, this is just an updated chart from the one from the EIA. North America is showing some of that slowdowns that we've been talking about, but seasonally speaking, it's there's normally a little bit of a lull until we get towards that July 4th. Asia Pacific is the one that we've been talking about that is just following 22 levels, and as you get more and more pressure on the economic front, that's going to fall a bit faster. And then here, when you look at Europe, you're getting a nice little bump, which if you look at 22 was the same time period that you got that nice bump. And then we do expect to see a bit of a drop off as we go into the beginning of July. On the China side, you can see that we had a nice little increase, but again, it's right in line with where we were in 22. So there's still nothing to show us that there's anything really different versus last year. And the expectation was that you were going to be above last year because remember, 22 had a lot of lockdowns. You had a lot of different back and forth when you're looking at restrictions. And you're just not seeing the same level of activity. And you can see based on some of the different key cities how there's that mix and match in terms of, because remember Shanghai, Beijing had some sizable lockdowns where other places didn't. And so when you average it out, we're right where we were last year. Now, the one thing that's going to be interesting is as we head into July, because if you, for those that haven't seen, there's about 10 million barrels that have been taken off the market, that have been reduced by 3 different refiners that will be buying from Saudi Arabia. So what does that mean? It just means that when they went to Saudi to tell them how much volume they wanted in July, the net reduction was 10 million barrels. So that's going to continue. But when you look at the data, end of June to middle of July is really the slowest point of Chinese buying. And that's where, when you play into the whole goal, there's no reason why China should increase their buying just given where prices are. So you're going to see this number, which is just looking at super tanker imports, will remain elevated. It's going to show some additional buying, and it's because they're purchasing from Russia, but you're not going to see the same level of buying from Saudi, especially when you look at those economic indicators. This was, I thought, a good summary from the econ show that we did earlier on China, industrial production, retail sales. Again, you're seeing that momentum really start to fade. And as this chart then shows on the right, early strength in property and exports have reversed sharply in May. And again, it's just the trend, that trajectory continues to be on the downward front. Then when you look at the U.S., Americans are keeping their cars longer, and I thought this was good at looking at the average car type. And this is why when people talk about the replacement of gasoline into EVs and everything else, it's like it takes time to do that. And when you look at the average age, we're close to about 12.5 years, up 3 months from 22. And if you look at new prices for cars, the rates, no one's rushing out to go buy a new car at this point. So you're going to try to make that last and extend some of that to keep it the same. But still, you're still seeing an increase in fuel efficiency because a lot of these cars, even though they're increasing in age, 10 years ago, 12 years ago, there was a big shift in terms of increasing miles per gallon. And that continues to, again, help us when you look at that underlying reduction of total consumption. Now, when you look at consumer sentiment index came in at 63.9 versus the estimate of 60. Expectations 61.3 versus last month of 55.4. Again, just bouncing around the lows. It's all going to be based on how people feel about their situation, where things are. But you can see that we haven't seen any real improvement to the upside. And we think, again, we just stay at these depressed levels and just bounce back and forth. Now, when you look at inflation expectation, for June, it fell 3.3%, the lowest since March 2021, but you can still see the expectation is much higher than it has been in previous years. And again, it's just still showing that people are feeling a little bit better about it, but not to the degree where it's back towards where realistically the Fed would like us to believe it's going to be. And I don't think this has been priced in fully, which is why you're going to see some additional reductions in that Michigan number, and it's just going to be something to watch. Latest CFO survey shows hiring expectations have declined. Median growth rate for annual payroll has fallen to 0%. Less than half of CFOs expect employment at their firm to expand, unseen since depths of pandemic in 2020. So again, it's just showing you that there's that pressure's building. There's more of that slowdown, and these are things that will impact expectations, reduce people's spending, as well as elevated pricing. The trend and outlook is for weaker retail sales. Again, just talking about what we've been highlighting in terms of willingness to make consumer loans, CRE loans. Banks are just continuing to tighten up, which is why that's going to be a downward pull on some of this on the sales. Inventory to sales ratio remains at the higher end. That's something that, again, is going to stay within those levels as sales slow and inventories remain fairly elevated. Just picking up on China FDI, foreign direct investment, continues to fall. Now, it's important to see that it normally falls this time of year, but you can see it just the rate of change accelerated. It's much lower than where we were in 22 and 21. And as we've been saying, as people nearshoring, onshoring, moving away from China, this is going to continue to be a headwind. Now, some of the key pieces that we like to talk about is the agriculture, commodities versus food prices. Food prices have shifted higher because of weather, because of concerns over the Black Sea deal. Agriculture commodity prices are sharply moving higher again, suggesting that food prices are going to follow. Again, more issues for inflation and the emerging markets. Commodity cycle is at its early innings, and the appreciation in natural resources after the COVID recession was likely just the initial phase. Bull and bear markets, can move back and forth, but realistically, when we look at this in general, we remain more concerned on where food prices are going, and we do see them shifting higher because of ag, because of commodities, because of rates, and just the lack of volume because of falling yields. So that's what we have for you today. If you have any questions, please let us know. We hope you have a great long weekend, celebrating Juneteenth and getting that extra day in under your belt. Can't complain, especially ahead of what will likely be hopefully an enjoyable 4th of July for everyone. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.